Welcome to The Tax Factor, the UK's top tax podcast from Blick Rothenberg, the tax, accounting and business advisory firm. This week with Matt Crawford and Suzanne Briggs.
Welcome to The Tax Factor, the UK's top tax podcast. I'm Matt Crawford.
And I'm Suzanne Briggs.
This week, we're going to be talking about new powers to clamp down on tax avoidance, a home loan case in the Upper Tribunal that didn't go HMRC's way, and why cricket is in the tax news this week. But first, Suze, what's been making the tax headlines this week?
The Tax Factor headlines.
First up, the OECD has given the UK a rather unwelcome badge of honour. We're set to have the highest inflation in the G7 next year at around 3.5%. A big part of the problem is tax-related, hikes in employer NIC, increases in regulated costs, and the prospect of further tax rises, all feeding through into prices. It's a reminder that tax policy is not a remote academic thing talked about by experts. It lands in the cost of living. Next, a subject that we regularly talk about, and our CEO Nimesh often talks about, what some are calling a stealth tax. The freeze on income tax thresholds is still doing its work in the background, and a new analysis suggests it could leave the average worker nearly £300 a year worse off by 2030. It's one of those technical measures that doesn't grab the headlines every day, but over time, it quietly shifts a lot more money from people's pay packets into the Treasury's coffers. And finally, government borrowing figures aren't looking too clever. Between April and August, borrowing came in at nearly 84 billion. That's more than 11 billion higher than the official forecast. Lower than expected tax receipts are a key reason, which puts more pressure on the Chancellor to find new revenue. Those calls for tax rises aren't going away anytime soon.
Like Mally last week, I was hoping for some light relief with maybe a biscuity or chocolatey VAT scandal, but I guess the theme this autumn is everything very much is pointing towards that late November budget, which really does have some heavy lifting to do. Suze, on that subject, I know you've been looking into some proposals by the Resolution Foundation in advance of the November budget.
Yes, thanks, Matt. A report by the think tank, the Resolution Foundation, has told Rachel Reeves to break Labour's manifesto promise and to increase income tax by 2p and at the same time cut employee NIC by the same amount. The rationale behind this recommendation is to, in inverted commas, level the playing field and tackle unfairness in the tax system so that non-salaried people such as pensioners, landlords and the self-employed will pay more, while salaried workers would not see further increases in their tax bills. This is estimated to raise £6 billion. The foundation also recommended a number of other things, including raising taxes on dividends, lowering the VAT threshold from the current 90,000 to 30,000. This move alone would raise an additional £2 billion. In addition, it was recommended that extending the existing freeze on income tax thresholds into 2029 would raise a further £7.5 billion. And as I said just now, I know that my learned colleagues have talked about this at length and the consequences of fiscal drag, but this would have a following compounding effect. So I think it's worth keeping an eye on what the Resolution Foundation says, as previous recommendations have been followed, including the changes to business property relief announced in the last budget. The foundation seems to have more and more influence on government policy, which is perceived by many as concerning. At her first budget last October and an estimated 40 billion tax raid, Rachel Reeves said that they would not be coming back with more tax increases. It seems therefore that there will be a further U-turn in the forthcoming budget, as the Resolution Foundation estimated that she would need to raise taxes by 20 billion. Some have suggested that the figure could be as high as 51 billion. Where does it end? There have been various criticisms of the report, in particular the added pressures that tax increases will add and the potential impact on inflation and the economy. As I mentioned at the start, an OECD report issued warned that UK inflation will be the highest in the G7 this year and above average for the G20, estimated to be 3.5% compared to 2.5% last year. Conversely, the OECD marginally upgraded its economic growth forecast in the UK from 1.3% to 1.4%, the second fastest rate in the G7 after the US, which is feeling the impact of tariffs and trade uncertainty. As ever, Rachel Reeves has pounced focused on this sliver of positivity, saying that the British economy is stronger than forecast. However, it remains to be seen how the balance of inflation, the fiscal black hole, and expected tax rises will impact on this growth figure. Back to the Resolution Foundation report, there is also a proposal to introduce a salt and sugar tax, although it is acknowledged that this would have an impact on food inflation, which is already running at more than 5%. If this proposal goes ahead, my two favourite things, salt and vinegar crisps, would go up by 2% and dairy milk by a whopping 13%.
That's pretty hefty, isn't it? I came up with a really good idea when they first introduced the sugar tax, but I couldn't get anyone to go along with it. It was a bit of an avoidance scheme, which was, I seem to recall that the sugar tax only applied if the sugar was actually dissolved in the drink. So I thought you could do a bit like salt and shake crisps, but you could do kind of sugar and shake Coca-Cola, for example, and sort of have the bits on the outside, the sugar cubes on the outside, to drop in, give it a shake, and you'd avoid your sugar tax. But no one took me up on that particular avoidance opportunity. And I also saw an interesting point in the same proposal, a bit more seriously, Suzanne, that you were talking about from the Resolution Foundation, of the possibility of putting employers' national insurance on profit share from LLPs, which will scare lots of people in our industry, no doubt. And back on the subject of tax avoidance, but not on sugar this time in my rather silly ideas, I've been looking at some pretty draconian proposed legislation regarding tax avoidance, which has just been published. Draft legislation was published. It gives some really sweeping powers to clamp down on both the promoters of tax avoidance and tax avoiders themselves. I haven't got time to go through absolutely all of the different measures that are in the draft legislation, because otherwise this would be a podcast as long as some of Neil Insel's versions. But I will give a bit of a highlight. One of the things it does is it includes a strict liability offence on offences under the disclosure of tax avoidance scheme rules. And those that are familiar with the DOTAS rules will know that it includes some pretty difficult and nuanced hallmarks to decide if something is disclosable. And introducing a strict liability criminal offence for a promoter of a scheme on that is really pretty draconian and could lead to people who simply have made a mistake in interpreting the DOTAS rules, which, as I say, aren't easy, being criminally liable. It also includes increased civil penalties of up to £1 million. And unlike the current DOTAS regime, there isn't any FTT oversight that I can see in terms of HMRC applying those penalties. So there could be a lot of worry out there on those particular issues. And if you're interested, one of the best things to read that I've seen is both the ATT and the ICAEW submissions to HMRC on the draft legislation on that. I think they're very well written. The other thing that's interesting that it includes something called universal stop notices. We're familiar with the old stop notices, which are sent to a promoter of a particular scheme. So if I came up with my wonderful sugar plan, then they would send me that scheme. But I could go off and I could have a new company and call it Sugar Tax Avoidance Number 2 Limited, and that potentially wouldn't work. Well, now they're going to be able to do something rather different, and they're going to be able to do a universal stop notice, which would apply to all such egregious sugar tax avoidance plans, and then everyone would have to obey it. And again, penalties for not doing so. Again, also worrying, because how does one disseminate that particular scheme has been hit by a universal stop notice? So yeah, a lot out there. There's a lot more in there as well for financial institutions too, but it's definitely something that I would encourage everyone that works in the industry to read, because I do think it's going to be quite significant. But in some slightly more positive news for the taxpayer, I understand there's been a case where HMRC have lost an appeal in the Upper Tribunal, which isn't something that happens every day.
No, it isn't. And it's just a case that might be of interest to fellow tax geeks, actually. The Elborne case, actually, the decision was released a few months ago, but I wanted to talk about it because it's a significant win for the taxpayer. And as you just said, Matt, it's unusual because HMRC in this situation have won several predecessor cases, but only at the lower tribunal. This case made it up to the upper tribunal, so it is significant. And it could save families significant amounts of IHT, with the health warning, of course, that it is expected that HMRC are likely to appeal the decision. The case concerns an IHT avoidance scheme that we saw quite a bit of in the 1990s and early 2000s before anti-avoidance legislation was introduced, which made these schemes unworkable. But the schemes that were put in place before the anti-avoidance legislation came in, advocates of the scheme have always said that these arrangements worked. But there's been a significant period of uncertainty because HMRC have argued that the schemes don't work, and we've had to wait for arrangements to be tested in the tribunals. And because the scheme concerns IHT, it's meant that many cases haven't ended up in the tribunal until the taxpayer who might have entered into the scheme has passed away, and it's the executors of the estate taking the case. In the meantime, due to the uncertainty, some taxpayers have looked to unravel the home loan scheme that they entered into, but this is also marred with complexity and potential tax charges. So specialist tax advice is always recommended. So this is the home loan scheme or the double trust scheme, which was used to avoid IHT in the family home. They were only around for a few years, but it is estimated that some 30,000 of these schemes were put in place. Now, there were many variants of the scheme itself, but broadly it involved the taxpayer giving their home to a life interest trust in exchange for a loan note, which was subsequently gifted to another trust for the benefit of the family. Provided the taxpayer survived for 7 years, the gift of the loan note would fall outside of the estate, and on death, the value of the loan note would be deducted from the value of the house in trust, thereby saving the IHT. So HMRC stated that these schemes don't work. There were several legislative changes, including changes to SDLT, the Crown Asset Tax legislation, and IHT changes to trusts in 2006, meaning that it was no longer possible to set up a life interest trust without an immediate charge to IHT. So as I said, HMRC won several cases, which meant that inheritance tax became due on the entire value of the family home. These schemes were not effective. This case, the Elborne case, focused on the deductibility of the loan under Section 103 of the Finance Act 1986, which basically denies a deduction for artificial liabilities. The Elborne case made it to the Upper Tribunal, and it's important because it decided that the scheme was effective and allowed a deduction for the value of the loan note. We should watch this space, and in the meantime recommend that anyone with a home loan scheme in place takes professional advice. Staying on the theme of case law, Matt, why don't you finish this week's episode off by explaining how someone ended up with a rather sticky wicket?
Brilliant. Yeah, very much so. So this is a case involving Paul Collingwood, the cricketer who I believe played for Durham County Cricket Club. He was entitled to some sponsorship income, which included image right, and he assigned those image rights to a company of his. And actually, back in 2005, there was a previous inquiry by HMRC, which was closed in Paul Collingwood and his company's favour. And the first aspect of this case in front of the FTT always amazes me that taxpayers are continuing to try this, because the FTT have said it time and time again. The argument was that because HMRC had found that the taxpayer was correct in the first closed case, that there was a legitimate expectation that he could continue working in that way. And of course, the FTT said what they always say in these cases, which is there might well be, there might well not be, but we're not going to look into it because we don't have jurisdiction to hear legitimate expectation, which is a public law point for the administrative courts and not something for the FTT. My personal view is that it wouldn't be a proper legitimate expectation in any case, even if it was in front of the administrative courts. But it's incredible how often taxpayers try and say, but HMRC told me once it was okay, therefore surely it must be okay now. And that simply doesn't work, especially not in front of the wrong tribunal. But in terms of the actual issue itself, the FTT found that because he was legally entitled to the sponsorship income, the contract were with him, the fact that he'd assigned those rights to his company, that wasn't effective because the legislation says who is the person receiving or entitled to receive the trading profits, and that remained Paul Collingwood. It kind of reminds me actually of some of the employment status cases that I look at kind of in my world, in that there are kind of effectively two gateways now that you need to get through. You have the legal and contractual gateway, and then secondly, the substance gateway. And first, you have to look at that legal and contractual gateway. And if the contract says the contract is with person X, then you probably don't need to look any further. The contract was with Paul Collingwood in this case, and the fact he'd assigned rights later was an irrelevance. And then only next then do you look at the actual substance of what's going on. And that really does seem to be that in lots of tribunal cases, that is the approach that the courts are taking. And also on the cricket theme, there was an awful lot of noise this week. This is more on the spend side than the tax side, that Cambridge University has managed to get itself some government funding for research into whether bamboo cricket bats can be just as effective as willow cricket bats. So be some bad news for, I'm sure Jeremy Clarkson planted a load of willow trees, didn't he, in his farm to be harvested in the future. So it might be bad news for him, and it might be better. We might be all better off planting some willow.
Blick Rothenberg, celebrating 80 years.
But I'm afraid that's all we have time for this week. As you know, we release a new episode of The Tax Factor every week on the Blick Rothenberg website and through all of the usual platforms, so you can listen wherever is most convenient for you. We record and release them in less than 24 hours, so you always get the very latest news and updates.
If you enjoyed the podcast, please subscribe and give us a rating or review. And with the budget coming up, do keep an eye on our website for the very latest news and insights. You can also sign up for our budget insights and emails, as well as updates on many other topics. Next week, our colleague Robert Salter will be here, so do join us again.
But from us, it's goodbye and have a good weekend.
Goodbye.
That's the Tax Factor. Since launching in August 2023, we've become the UK's top tax podcast in the UK podcast chart. Join us every Friday for expert insight on the latest tax news. Subscribe on your preferred podcast platform or listen direct on the Blick Rothenberg website, where you can also find the latest updates and analysis. The Tax Factor from Blick Rothenberg. Copyright 2025.